Well, hello everyone, and we're ready to get started. My name is Deep Sen Gupta, the founder of DSG Global Academy, and I'm delighted to introduce you to today's webinar, which is Best Practices for Setting Up a Global International Trade Compliance Program. We've got 90 minutes today, but I promise you I'm going to keep it as interesting and filled with examples and anecdotes. And we'll also have ample time for questions and answers. What I'm going to be talking about during this presentation is really what are the benefits of having a global compliance program. And when I say global, emphasis is really on worldwide in multi-countries and different jurisdictions, rather than just focusing on global compliance, which is what we do in our jobs in the United States. But my focus of this presentation is how do you manage other countries as well. I'm also going to look at the challenges that many companies face in setting up this global program. I'm also going to talk about some best practices that I've picked up along the way through many of my client projects and interactions. I'm going to be talking about the major risks in number 4 that you need to monitor from an import and export compliance perspective. And finally, rolling out and monitoring this global compliance program. But before I get started, I just want to share with you and how I got into this field, not of the field of international trade or international trade compliance, but this field of doing worldwide compliance programs. About 10 years ago, I had a client who was a pharmaceutical company in the United States, and they had a customs audit. They didn't expect it, and customs found penalties worth 7 digits, and the lawyer fees were worth 6 digits. And then the upper management said, whoa, if we are the headquarters and we have such a huge, tens of millions of customs penalties, guess how bad we must be in the 71 other countries we are doing business in, right? So all of a sudden, they sent out this RFP and they tried to select from law firms, accounting firms. And at that time, I managed the trade compliance group of FedEx, one of the largest carriers in the world, and we were selected. And during that time, this project, we really had to analyze how this company was doing in different countries. So a lot of my best practices have been learned from that project, which we've tried and tested and perfected over many other customers through many other countries. So this is distilled wisdom that I'd love to share with you today. So the benefits of having a global compliance program is obviously consistency, efficiency. You're really cutting down on delays. You're reducing avoidable penalties. And you're speeding up the whole transit time and the clearance process. Coming from a carrier perspective, I know that companies who do it right the first time save a lot of time, effort, and money in going back 5 years and fixing the problem, or having to pay penalties to the government. And what we also see from a transportation perspective is companies that have demonstrated compliance and have a good compliance reputation and history usually are the companies that face fewer cargo holds, fewer delays, and time is money, right? So that's the benefit of having global compliance. You can reduce your customs duties, you can reduce your penalties, and speed up the whole process in a legal way. Now let's talk about global teams that I see around the world. Around the world, depending upon the size and the nature of the business, typically global teams are located within each continent. For example, suppose you're a US-based multinational with its global headquarters in, let's say, Los Angeles. Usually the Los Angeles office isn't managing every country, right? The trade compliance in every country. You have a tiny trade compliance team, usually within every continent. And maybe the people in Asia might be based in Singapore, might be responsible for trade compliance in Asia. Maybe somebody in Dubai or the UAE could be managing trade compliance for Northern Africa and other Arab nations. Maybe somebody in Sao Paulo, Brazil, could be managing trade compliance for South America. So usually that's what we see. We also see that these trade compliance professionals typically do not report to you, who's the trade compliance head in North America, but they report to the local factory manager, who's the general manager of that facility, but they do have a dotted line responsibility to you. So that creates some politics because you always need to get the buy-in of their direct manager, who is usually the facilities general manager, who all they care about is getting the product out the door, and they don't share the same passion you may have for trade compliance. There is a common IT and ERP platform. That's a great thing. So they can see the commercial invoices, they can see the part list, and other shared information. And like other virtual teams, you'll all face the same challenges of the time zone difference. And when you come to work, they've just gotten off work, and so on and so forth. So you could lose a couple of days. I've seen, rather than being super efficient, usually it builds in some delays in the decision-making process. So those of you who are new to exporting to any country, and I deal with a lot of small to medium-sized companies as well who are brand new to exporting. They've got this fantastic product which isn't even listed on the harmonized tariff because it's so cutting edge. And for example, I'll give you an example of a customer of mine that makes these eyeglasses, but they're called augmented and virtual reality eyeglasses. You put them on, and they say it's like having an iPad. You can browse the whole computer. So these are cutting edge products, and they advertised on in the Consumer Electronics Show in Vegas in January, and they got inquiries from over 50 countries around the world. And that's when they brought me in. So the first steps for any country are the following. You need to find out the harmonized code for your product. Now remember, the US harmonized codes are valid in other countries only for the first 6 digits. It's the common around the world for the first 6 digits. But if you use a US code to export, chances are, if your goods are held up for an inspection, the foreign customs inspector, be it say in Brazil or China, would not recognize the last 4 digits of that 10-digit code, right? So that might cause delays or additional penalties. Number 2, always find out what your effective customs duty rate is to avoid any surprises. For instance, not only what the customs duty rate is, but what are the other applicable import taxes like GST, VAT. Some countries in Europe, not some countries, most countries, VAT exceeds 20%. Also, there are countries such as India and Brazil where there are several cascading import taxes, the reason I say cascading is because they're calculated on a compound basis, one on top of the other, not only on the value. So it gets really complicated. So to avoid any sticker shock, find out ahead of time. Also find out what the import and export requirements are for your product in specific and in general for getting into that country. Also find out if there's any restrictions or license requirements, especially if you're dealing with chemicals, food products, medicines, medical devices, any wireless emitting items. Find out the documents you need for importing into that country so that finally when the shipping clerk tries to get it out by the 3 p.m. deadline, you don't realize that there's some other documentation needed. Or the worst case, when your goods land up in Saudi Arabia, you find out that you needed a consularized invoice, or your goods land up at the port of Mumbai in India, and you find out that you needed something called an importer-exporter code number, which takes, guess what, at least a month to get. So the last thing you need to check is procedures for RMA. Suppose your customer doesn't like it and returns it or says it's defective. What are the procedures for shipping it back out to the US and then bringing a replacement product back in? Many countries, unfortunately, will charge you full duties again. More the developing countries that don't have provisions for, American goods return, for example, Chapter 98. So find out these answers to these 5 questions if you're new to import. New to export. Let me also say that the focus of this webinar is not on companies that are new to export. But since we're dealing with international countries and exporting worldwide, I really wanted to put up this slide because many companies, when they ship international, they forget to follow these steps, and then they're in for a rude shock. With that said, let's now get into the main portion of our presentation, which is setting up a global trade compliance program. So imagine you were in the position that my customer was in, where their general counsel says, you know what, we failed a customs audit in the States, and we put together a good program in the States, but now I want you to set up a global trade compliance program, and you have the full backing of the board of directors, do whatever it takes. Right? So the first thing that I recommend, and I'm just going to list the first 3 steps, and then I'll go into it in detail. The first step that I recommend is evaluate. Find out the current baseline. Find out which countries are worse than others, or which countries are top in the class, and which countries need, a little more TLC, 10 to 11 care. Next step is, before I go to step 2, maybe the countries that are really doing poorly, and you find this out during your evaluation, you may need to even visit them, right? The second step is creating a compliance improvement plan, and you need to do this specific to each country. Once you do an evaluation and you have a scorecard, you will see which countries are worse off than others and their areas that they need more improvement in, so you can plug in the gaps. And finally, step 3, I recommend within a period of 6 months, no longer than that because it loses momentum. Within 6 months, go back, follow up, and monitor the changes that that country has made, that your subsidiary in that country has made with respect to its compliance improvement plan. So this is the framework we use, and I'd be delighted to get into more detail into each of the steps. The first step, evaluate. Now, what I recommend and what's helped many of my customers is setting up a questionnaire. It doesn't need to be too intricate. I remember my first questionnaire was 250 questions, and then slowly we whittled it down to double digits, in the 90s. But still, having a questionnaire is a great idea because it's not intrusive, you're not landing up there, you're not spending too much money, and creating a web-based questionnaire really means that you can roll this out across the many countries that you have a presence in. Usually companies, what they do is they don't use SurveyMonkey, they create an intralink, so it's behind their secure firewall. And, we list the major areas of risk, and, there's a scoring. The score could be, do you have these procedures in place? Do you do anything? No, 0. Yes, we do, but we don't have procedures in place. And the best ranking is obviously that you do something and you have a good procedure in place. And some companies that have best-in-class practices, which should be adopted across your enterprise, they get top marks because it's a best-in-class practice. So once we do this scorecard method and we send it out to your local countries, now remember, maybe there are some questions in the questionnaire that your trade compliance person in that country, let's say Malaysia, is not qualified to answer because it's a little finance-oriented. So, assign other people as well, such as finance, shipping, receiving, tax, who can answer those questions. And it's very important as you roll this evaluation out that you have upper management support, because everybody is busy around the world. And if you're not, I'm sorry to say this, but usually the legal team is a great whip or a C-level executive to say that we are doing a benchmark analysis of our trade compliance worldwide, and it's imperative that the local countries support this initiative and complete this questionnaire within, say, 2 weeks. And if you have any questions, contact Mr. or Mrs. Trade compliance person, right, in the States. So what this evaluation does, and when you get the feedback, and the evaluation also kind of generates a score. So it's based on a scorecard. So you can see the score for every country. Not only can you highlight which countries have failed, in a sense. I hate to use the word failed, but there's got to be a level which is below acceptable, right? The minimum. Then those countries are high risk. The countries that have done really well, you don't need to worry about them as much because they have good procedures, they have good internal controls, they've done previous audits, they have a good record-keeping procedure. And then, based on the significance of those countries in your own corporation, for instance, maybe you have a manufacturing unit in China, so it's far more important to you than, say, Indonesia or some other country, South Korea. So based on that that priority, you can maybe decide to go and visit them if their trade compliance score was very low. Visiting countries is obviously the gold standard because you can see exactly what they're doing. You can speak with them, find out really what the history was, where they're not getting support, what support they need. But in order to select which countries you need to visit, I highly recommend doing this online benchmarking evaluation first. Once I've done this evaluation for a company, and you identify out of the 50 countries you do business in, which 10 are highest risk, which are lowest risk, which are moderate risk, I always recommend creating global standards. Global standards is really like your import and export policy and procedures manual, but you're creating it on a global level. Now, many of you might say, oh, that's impossible because global rules are different. And I totally agree with you. That's why I suggest creating some standards, which are some very short instructions or benchmarks that every country needs to follow and incorporate in their own individual customized import-export policies and procedures. Let me give you some more detail. Now, the United States Customs Service, as it was called at that time, used to do what's known as customs assessments. These were the full-blown compliance audits, which used to last at least a month or a year. And this was before the year 2002, when Customs came out and said, guess what? We're issuing a friendly audit. It's called a focused assessment, right? And old-timers who remember that probably shocked that 15 years have gone by. But when Customs did the focused assessment and introduced the focused assessment 15 years ago, they were in a period of transition because they moved from the Department of Treasury after the tragic incidents of 9/11, and they moved to the newly created Department of Homeland Security. And all of a sudden, their main priority was not customs compliance and generating customs, collecting customs duties. Their main objective was to protect the United States borders from terrorists and weapons of mass destruction, right? So they had limited resources, limited funds, limited teams and personnel to do customs audits. So they came up with a brilliant analysis. They went back to over 400 customs audits that they had done in the previous decade. And they studied this and they said, there are many of these customs audits that we did where after spending a year on site, reviewing entries, trying to find mistakes, we came up empty-handed because the company was in great shape. So how do we identify those companies that are in great shape so we don't waste our time on them and focus our time on non-compliant companies where our return on investment will be a lot higher, right? We'll be able to collect more penalties for non-compliance. And what they found was there was one parameter or one factor and characteristic that separated the good from the bad. Sorry, and that was internal controls. What they found, and let me just tell you what internal controls means. Internal controls means having procedures, personnel, training, and a good culture of compliance, right? Management support. And they found out that internal controls was a good predictor of customs compliance. And let's see what they specifically saw. They saw that companies that did have good internal controls, that means they had written procedures, management support, training, identified responsible individuals, they had a very minimal duty recovery at the end of an audit, just about $40,000. And that was peanuts, really, some error here and there. But they saw that companies that did not have good internal controls, which really means it must have been chaos or doing business by the seat of their pants, literally, these companies, the average revenue recovery was 9 times higher at an average of $428,000. That's just under $500,000 per company. So that's when customs had its aha moment. And then when they rolled out the focused assessment in the year 2002, they used this finding, and what they did is they created a 2-tiered customs audit. The first tier is where they are going to check your internal controls. It's called the pre-assessment survey. Think of it just like our little evaluation we're doing globally. And if companies demonstrate that they have good internal controls across all risk areas like valuation, classification, country of origin, record keeping, free trade agreements, so on and so forth, customs isn't going to waste their time, and they're going to move on to another company, and they're going to give you a low risk audit opinion. But if a company fails this pre-assessment survey and shows that it does not have good internal controls or acceptable internal controls, that's when customs is going to go to the next phase, which is the full-blown assessment compliance testing, where they ask for more entries and they try to drill down and collect a loss in revenue, right? So we used the same approach. And what we decided is that in order to get a country up to snuff and fully compliant is a difficult job, but let's first start with building internal controls. And rather than telling Brazil, India, China, Malaysia, Argentina what to do and create their procedures for them, the easiest way to do it is by sending them. What we came up with was 25 core elements that need to be present in their trade compliance policy and procedures. And these 25 elements is what we call your global import-export standards. It just has to be a couple of pages. If any of you are interested, I'm delighted to share copies of the evaluation questions as well as these, global import-export standards. Just send me an email. And what we do is we send these standards to your individual, you send these standards to your individual countries and say, create your own country policies based on these standards, right? So what are these standards? There are a total of 25 key elements, which are these standards. And I've just listed the heading. In the actual document, we'll add a paragraph under management commitment, a whole paragraph under organizational structure. We'll provide a little more detail on what that country's policy needs to have in place. But these are the 10 administrative elements, and there's 15 technical import-export elements. And through many years of trial and error, we've seen that these elements pretty much cover, these 25 elements pretty much cover almost 95% of things that can go wrong on a global basis across most countries, So at least having a policy and standards can minimize and mitigate your potential exposure. So let's quickly go over what these administrative elements are. Number one, you've got to have a statement of management commitment. And I'll go into detail for each of these in a little bit. I'm just reading it out right now. Number two, organizational structure. Who do you report to? Number three, having a formal written program. Number four, continuous risk assessment, which is internal audits, external audits. Number five, ongoing compliance training and awareness. Awareness means spreading the knowledge across your other related teams as well. Cost improvement, what this means is you can't reduce your customs duty costs unless you know how much you're spending. So find out how much you're spending in duties and taxes and have some goals for reducing or strategies for minimizing that duty and tax spend. Trade data management, records management. Number 9, handling compliance risks. Number 10, taking corrective action. Sorry for reading this, but I'm going to go into more detail in subsequent slides. The technical elements are 15, a total of 10 administrative and 10 technical. The technical elements are: what are specific licensing requirements for your product? What are other government agency requirements, or as known as in the United States now as participating government agencies, PGAs? Number 3, flowchart your whole import process, flowchart your export process and know where things can go wrong and assign responsibilities. Number 5, customs valuation. This is a very big deal. And obviously, if you're dealing with a related party and you're dealing with your entities around the world, number 6 is very critical, which is related party valuation issues. Number 7, product tariff classification. Number 8, free trade agreements. Number 9, country of origin. Number 10, post-activity review, like a post-entry review. Number 11, embargo management. Number 12, restricted party screening. Number 13, broker selection and management. Number 14, managing other service providers or selecting other service providers. Number 15, global supply chain security. Friends, I want to apologize for reading through those 3 slides, but I just want to highlight what these 25 major elements are before jumping right into it. So let's go over the standards, and this is just a very brief summary of each of the standards, so just to give you an idea of what instructions you should be sending your worldwide entities. Number 1, management commitment. What we're saying is that every local area management needs to issue a guidance saying that they're committed to import-export compliance and that they support the local in-country trade compliance manager or supervisor, and there would be repercussions for any non-compliant activity. So that needs to be loud and clear. Number 2, many countries say we don't have the budget for maybe a trade compliance person, and that may be the case, but to the extent possible, the subsidiary should be instructed to provide sufficient resources to the import-export person. Resources is usually a head count. Sometimes there could be, I've seen operations person or a purchasing person who also has the title of the trade compliance officer. And what's important here is that if your business operations are too small and you can't have a full-time trade compliance person, at least have a clear designation of who is responsible for import-export activity in that country. This is very clear. This is really the most important thing that we're doing in this phase, is creating those internal controls that address the major 25 risk areas. Every foreign country, I call them affiliate or subsidiary interchangeably, should have these written instructions customized for their country based on your corporate standards. Continuous risk assessment is very important. Maybe you can provide them with some audit points where, at least on an annual or 6-monthly, half-yearly basis, they review selected entries and they check that questionnaire for, is the value correct? Is the HTS correct? Is the proper records being retained? Now, what I tell people is doing your own audit is kind of defeats the purpose. It's almost like somebody asking you in an interview, tell me about your weaknesses. And, you know, that's a very difficult question to answer, right? Because, you know, you think you're perfect. So similarly, having your own department doing an audit on yourself is probably not a good idea. So I always recommend maybe having the quality team or the audit team or the finance team or a related team come in for a day or a half a day and review your documentation for you. So that's far more effective. Obviously, getting external consultants is costly, but there is a merit every couple of years. Ongoing compliance and training is very important, not only for the trade compliance person to get the training, but also for other related people to get the knowledge. You can do this through sending out emails. Maybe there's an intranet for trade compliance in your company. One thing that I found really helpful is in smaller to medium-sized companies, creating an international trade council. Council as in committee, not lawyer. And this committee meets every 3 months and they have members from all the related divisions like supply chain, warehouse, tax, legal, purchasing, R&D, and you know, meeting on a 3-monthly basis, y'all can discuss issues that have come up pertaining to international trade that impacts everybody. And what that does is 2 things. That creates an awareness of international trade, but more importantly, it lessens the burden on that trade compliance manager. It makes it a shared responsibility where all the other divisions and departments know that they have a role to play and they give better support and cooperation. Cost improvement, when you do your initial evaluation of different countries and you ask them how much customs duties they paid in the last year, last 2 years, they're going to have a tough time getting this information because they've got to go to their finance department, they've got to run reports on your ERP, but this information is critical. When I have done overseas audits, I've seen many miscellaneous and additional charges that just went through uninspected and not scrutinized. So identifying how much you're spending and creating a goal of not spending more than that and trying to find strategies to spend less than that is a great idea. The joke is that international companies have large teams of tax lawyers and tax experts to reduce your effective corporate tax rate by a couple of percentage points. But when you'll get your customs duty bill from your carrier or freight forwarder, you'll just stamp it reviewed and send it to accounts payable, right? So what I'd like companies to do is really spend more time analyzing their customs duty spend because there are many opportunities for reducing it. And if you don't examine your bills, you might be overpaying. So I just want to mention that cost improvement as a strategy. Trade data management, essentially having a log or a record of all your imports and exports. That's fairly basic, but many companies don't do it. Some companies do it in a spreadsheet form. Others have a software. Either works as long as you have a log that covers all your import-export transactions with details. Record management. In the United States, the record-keeping rule for import and export documentation is 5 years. In Canada, it's 6 years. And in Mexico, it's 7 years. Around the world, different countries have their own rules on how long you need to maintain records. Companies have their own record keeping rules. So find out what the local country's rules are, or what I would say is, maybe you could default to 5 years, which is the US standards. There is a downside. Ideally, you don't want to keep records for longer than what the requirement is, so that you can say it's time barred or beyond the statute of limitations. But have this mentioned in your local country's policies as well, what the record keeping rules are, how long it should be stored for, what documentations should be stored also needs to be specified, as well as in what format it will be stored and by whom. For instance, many records are now being kept electronically as opposed to a paper copy. Furthermore, some records in a transaction are kept by finance. They keep proof of payment, they keep the PO, they keep the commercial invoice. Some records are kept by warehouse, such as proof of receipt and quantity verification. And then trade compliance may keep the other records for, the import entries, export manifest, bill of lading. So find out who keeps what, and maybe have a couple of common data elements that are a common thread, so that if you have to look up a customs entry by entry number, you also have the entry number and the invoice number, so you could look up multiple documents and not say, wow, how do I find this entry number, because we only keep the invoice number, right? So have a method of tracking. I was called by a company a couple of years ago, and they said, Deep, we've got a problem. We've got this huge penalty in Brazil that came out from a transfer pricing investigation, but our Brazilian entity just informed us about it. They kept it hidden for a while. They didn't tell us as in they didn't tell headquarters, which was based in the United States. We'd like you to go and find out exactly what went wrong. So I went down, and interestingly, I went down to Brazil with a colleague of mine who grew up in Brazil, is Brazilian, lived in the United States for the last 20 years, but obviously Portuguese is his native language. And when we went to investigate what this penalty was about, it was just under $10 million. What's very interesting is, first we spoke with the finance manager, and I kept nicely, in a nice way, grilling him. And then he said, you know what, we need to speak with my controller. And then the finance controller came in, and they were giving reasons of how it happened, when they knew about it. And then he said, I need to call my CFO. And then the CFO came in. And then for a long time, as we were in the room, the CFO, the controller, and the finance manager, they're all talking to themselves in Portuguese. So we excused ourselves, and I asked my colleague, what are they saying? And my colleague said, what they're trying to do is, he said, pull wool over our eyes, So the point is, many times, the biggest risk in a global company is you do not have visibility to what the ground reality is. So it's very important that you make a clear instruction that every time anybody receives a penalty or a notice, of a potential penalty from customs or revenue authorities, that the finance and legal team be informed, and so do you as the main trade compliance person in headquarters, because it's always important to find out these issues before it blows up. Possibly, if the issue in its infancy was you were informed about it, you could have sent legal counsel or asked them to contact legal counsel and nip it in the bud. So that's one area I've seen in many global companies where suddenly they find out that there's this audit happening in India or Sri Lanka or Korea, and it's too late to go and mitigate that risk. Corrective action. Many countries do not have the prior disclosure rules that the United States has, which is great. But still, try to find out if some countries have it, and if there are any benefits to reporting any error or violation. Please make a business decision and see if that works for you. With those 10 elements finished, let's jump in to the technical elements. I'll do it at a faster clip. Number one, always find out if your products need a license. And if they need a license, make a flow chart of the application process and the estimated timelines. That really helps, so that you know if something's getting delayed and something needs speeding up or a little more face time with the regulatory authorities. Other government agency requirements, this could be, the United States export licenses. In country, there could be license requirements as well, such as India has their own BIS. It doesn't deal with export controls. It deals with product safety and quality, and it's called Bureau of Indian Standards. And this is creating a lot of headache for my customers, because India's listed about 30 consumer electronics that need to be quality approved from some specified labs. And I've got some companies that are shipping their product into India. Suddenly they realize they need this quality control certificate, but it takes a minimum of 4 to 6 weeks to get this approval. So always find out ahead of time which products need a license or a certification prior to import. It's really important that I recommend flow charting your entire import process. This also will explain to people how much time is required at every stage of the process, so you have better visibility. Similarly, on the export process, very important to flow chart what the different phases and steps are. Commercial invoices, I recommend in global companies that they try to follow the same template and standards, general format, unless, of course, any specific country has unique requirements. This just makes it easier and consistent. Customs valuation. Those of you who have studied customs valuation and have read, the GATT and the WTO 6 rules for valuation, know that you can't just put any value. And most companies around the world, they know that you can't just put any value, and they use the transactional value method, which is the sales price. But invariably, I see that the goods that get held up are not the sales. They are the items that are non-commercial, such as samples, evaluation boards, demo, something that has software in it, a stock transfer between you and your warehouse or distributor. So all of these, and of course, related party pricing, which I'll discuss on the next page. So all of these different types of transactions that are non-commercial create a lot of risk and ambiguity. So what I recommend to all my customers is have a valuation policy written down that covers each of these different unique scenarios that keep coming up in your business, so that if you don't know what the valuation should be for an RMA, don't just put $10, right? Have a system that says, well, this is the market price, this is the salvage price, or if you're shipping a replacement or a repaired item, this is the rule in that country for replacement parts under warranty, or if it's repaired, maybe just having the repair cost. So having a valuation policy is really important and can save you potentially a lot of scrutiny and additional duties by customs. Related party issues. If I were to say the single biggest issue among all these 25 risk areas that I've seen in global companies with worldwide subsidiaries, it is this one. Let me give you an example. If for those of you who are not familiar with the technical aspects of transfer pricing, I give you the example of a Honda Corolla. It's a beautiful car. It's well priced, and imagine you had this Honda Corolla which you bought right after college. You bought it for $10,000. And now, 10 years later, the Blue Book value is $5,000. So it's gone down half. But your kid's sister has always wanted that car for some reason. And, when you're ready to upgrade to something nice, faster and shinier, she says, may I please buy that off you? And you bought it for $10,000, but the Blue Book value is now $5,000. So what are you going to sell it to her at? Are you going to sell it to her at $5,000? Or are you going to sell it to her for a token, $2,000 or $3,000, because you love her dearly? So, the truth is, if you have a heart, which, most people would give it to their younger sister at a discounted rate. So similarly, customs agencies realize that large corporations, they don't like to sell to their related parties at the full cost that they would sell to an unrelated party. They know that that's human nature to sell it at a discount. Now, that discounted sale is illegal, especially if you're declaring that discounted price as your customs value. Now, what customs has said in its 6 methods of valuation, the first is transaction value, which means the sales price is acceptable unless the relationship between related parties has influenced the price. So if you're selling to your related party at a price less than you would sell to any unrelated person, you cannot use the transaction value method, and you have to go down the list. And the other valuation methods as you go down the list is value of an identical good or value of a similar good. And then you can pick or choose between the deductive method, where you can take sales price to the final customer and subtract advertising and marketing expenses, or what many companies do, you can use the cost plus method. Now, here is the problem, because most countries around the world, when they ship to their related party, they use the cost of goods or the material cost, material value. Now, that is incorrect, because the cost plus method says you can use the cost of the goods plus a notional profit that's customary in your industry. So most countries don't do this. Most companies. So what I would recommend is, if you import or export from a related party, always have a valuation policy in place. I'm sure your tax department has transfer pricing policy, but that's purely from from a corporate tax perspective. But you need to have something from a customs duty perspective as well, just so that there's no scrutiny from customs authorities in the future. I can't tell you how important this particular point is, And if you have any specific questions, I'm delighted to get into more detail, either on the call or, if you call me later on. Product classification. Remember, product classification, there's a lot of merit to having this centralized. Companies that have a centralized database, you're making it easier for your local entities by telling them what the HTS codes are. Now, as I said before, the United States and all other countries have the same 6 digits. But beyond that, the last 4 digits are country specific. But you could do, if you're headquartered in the US, you could do your foreign countries a big favor by putting your product database, on the shared drive, so they know what the HTS codes are, and maybe you could even provide the destination country specific harmonized codes as well. I leave that up to you, but that's a best-in-class practice. Also, putting information such as the export control classification number or the ECCN number is very helpful, so that the local countries don't need to worry about finding out these ECCN numbers and HS numbers. I've also talked about, just ECCN numbers again, which I'll skip. Free trade agreements. Free trade agreements, if you're importing from a GSP country, which is a generalized system of preferences, or developing countries, or if you're importing from a NAFTA country or any other countries United States has free trade agreements with, such as Australia, Israel, Jordan, Korea, it's a great idea to have proper procedures to evaluate whether your products are eligible and what backup information your products need to qualify for the free trade agreement. Let me just tell you that there's something afoot by US Customs in the last week. They have been sending, in the last 10 days, they've been sending many notices to companies that use free trade agreements, and they're doing lots and lots of verifications. And what they're doing is, for example, if I've got a client that's using the US-Korea free trade agreement, and they're asking for bills of material from the manufacturer so they can actually do a free trade agreement verification. Customs is asking for this information. They're sending out CF-28s, right? So this customer of mine, they're one of the largest companies in the world. Everyone's heard of them. And they asked me, you know what, Deep? This is so cumbersome. How are we going to get our bills of material from our manufacturers in this other FTA free trade agreement country? And I was shocked, because every manufacturer should have the bill of material information, right? But there's this US company, they're claiming this free trade agreement, but they're saying, oh my God, it's going to be so cumbersome to get this BOM information, bill of material information, from our foreign suppliers. And I'm looking at them saying, wow, that should have been the first thing you did. Get this information before you claimed the free trade agreement treatment. So I just hope that what we're trying to do is we're trying to work with customs, and finally we'll have to work with the foreign manufacturer and get the bill of material. But the point I'm trying to make is that if you're using FTAs, getting your foreign manufacturers to be able to provide this information is critical. Country of origin. Country of origin is more of a data element that's more of a technicality, unless you're using a free trade agreement. In that case, it's important. But if you're not using a free trade agreement, a country of origin, honestly, is really just for data and statistics purposes. But one downside of a country of origin is if you have inaccurate country of information. Your paperwork says something, but your box says something else. Or if your packing list says something, but your commercial invoice says something else, then those discrepancies can flag your shipment or your entry for a little extra audit, for an intensive exam, a little extra scrutiny. So try to get your country of origin consistent and accurate. I recommend for most of my companies that they at least eyeball the entry documentation. You can do a sample review. If you get thousands and thousands of entries, maybe do a sample review of 5%. Really what you're checking for is any obvious human errors. Let me give you an example. You'll know that Japanese yen, millions of Japanese yen is just a couple of thousands of US dollars. Now, what if your broker got the currency rate wrong and it charged you millions and millions of dollars instead of millions and millions of the Japanese yen? So simple stuff like that can be caught by you doing an entry review, right? Otherwise, you'll just end up paying a lot of duty. Another example that I like to give people where even in the best run companies, there are mistakes. One day I got a frantic call from my customer, and they make computers. And they said, Deep, can you tell us why these materials would have been classified by a broker as articles of jewelry, specifically articles of silver? And I thought, wow. So I look at the description, I look at the product list, I look at the composition, I look at the entry, and then I realized that that HTS code that the broker had put for articles of jewelry and specifically silver jewelry, that exact number matched the tax ID of that company. So what happened is that the customs broker, who must have been working 14 hours that day, mistakenly typed in the IOR number in the HTS field. So they were classified wrong. So point being, human errors happen. Therefore, post-entry review is a great idea. If your product is, made in the United States or is made from US technology, or your subsidiaries are all subsidiaries of a US company, you need to realize that there are US export controls that you may be subject to. You may not need a license unless you exceed the 10 or 25% threshold, as the case may be, for having US content. But always be sure that your products are not shipped from your subsidiary countries to an embargoed nation. There are many, many examples where some extra zealous salespeople in Dubai might get your product saying, oh, we're just going to ship it to Saudi Arabia, but they end up shipping it to Syria or Iran. And it's legal for Dubai to ship to Syria and Iran, but it's not legal for you as a US company to have your product shipped there. So having these checks done, embargo checks, and also having the denied party screening done on a global basis is a great idea. The reason I mention broker freight forwarder is interesting. As I mentioned earlier, having a flow chart of your import process is a good idea. And I was once in Argentina helping the local subsidiary of a US company kind of audit and optimize their operations. And it was very interesting that the average customs clearance time was, around 3 weeks. And they were paying lots and lots of charges at every single step. And it almost felt like, whoa, why don't you just have a standard door-to-door rate, but this company was paying for demurrage, was paying late charges, was paying storage, was, you know, all sorts of things. And I asked the customs compliance person, who was also the purchasing manager, hey, who's this carrier that you use, this trucking company? They said, oh, our trucking company, our carrier this is a 3PL we use. We've got a long relationship. And I said, how did you select them? Did you do a kind of a RFP? Did you invite bids? Did you check the cost? They said, oh, no, we know them. They're great and all that. Okay. So later that evening, this customs compliance person was extremely hospitable and decided to take our team out for dinner and introduced me to his partner. And I asked him, his partner, just in conversation, turned out that she was in the same industry, logistics. And I said, oh, is that so? And which company do you work for? It turned out to be that same 3PL. So I'm not saying, but it was obviously, if there's more to that relationship, obviously that's where all the additional charges came in, and obviously it wasn't entirely kosher. So the point I'm trying to make is always ensure that your local subsidiaries have a good written verifiable selection process when they select service providers. That can minimize, obviously, all these hidden charges and ensure that you're dealing with a quality provider. And I also recommend having a list of key performance indicators so that on a quarterly basis, when you deal with your transportation providers in these countries, you're actually measuring their performance. This is a best-in-class practice. The reason I've mentioned other service providers is if you're using lawyers or consultants in country, always ensure that they follow the purchasing policy for your corporation. And finally, CTPAT. After the tragic incidents of 9/11, about 16 years ago, the United States came out with the CTPAT program, which is Customs Trade Partnership Against Terrorism. This program is great in ensuring that customs doesn't need to focus on reputable and known importers who join these programs, and can focus its limited energies, efforts, and resources on the unknown and suspicious importers. After US Customs took the lead, many customs agencies around the world have created their own versions of CTPAT. Many countries have combined cargo security with international trade compliance, notably Europe, which calls their program AEO, which is Authorized Economic Operators. And there's many other countries. There's Australia, there's Japan, Singapore. What I recommend to all companies is that if their local affiliates are in a country that has any cooperation program with their local customs authorities, they should definitely try to join those programs and create better collaboration and cooperation. It really pays in the long run to be on the good side of your customs, to have more visibility and to have those connections and channels of communication. Friends, so after you do the first phase evaluation and after the second phase, where you create your global standards and have every country create their own individual country program, I recommend monitoring that in 6 months. Monitoring, sending another questionnaire so you can see that their score has improved and they've got all their bases covered. This is really a best-in-class practice that has worked for dozens of companies that I've dealt with who struggle with managing a global trade compliance program on a worldwide basis. Well, with that, I'm thrilled to take any questions you may have.